prepayment of external debt, that includes our own and also the national governments, a financial sector reform to deepen and broaden the capital markets, and possibly only as a last resort, greater flexibility in the exchange rate, or letting the currency appreciate. So with the improvement in the risk appetite following the global crisis, the BSP took the opportunity to build up its foreign exchange reserves from around 45.6 billion as of January of last year. Our reserves have increased to about 66 billion as of end March. However, we also ensured that our foreign exchange purchases were sufficiently sterilized through swap operations to prevent undue increases in domestic liquidity. Along with swap operations, we continued to accept fixed-term deposits from banks and trust entities in order to help manage liquidity. At the same time, we sought to increase the demand for foreign exchange by voluntarily accelerating, as I've said, prepayment of external debt, and also relaxing the rules and capital outflows, particularly outward investments by Philippine residents. It should be noted that these macroeconomic policy responses were underpinned by existing macro-prudential measures, which have helped to make we believe have helped to make the Philippine economy less vulnerable or less prone to asset price escalations. For example, since the Asian crisis, the BSP has imposed a statutory limit of 20% on the share of real estate loans in banks' total loan portfolios. In addition, the maximum loan-to-value ratio has been limited to 70% for real estate loans, for a certain size of real estate loans, and loans also guaranteed by the government's national shelter program. The reinforcement of these regulations, as well as various laws on rent control and real estate investment trusts, have helped to temper increases in real estate prices. Over the long term, the key challenge for the BSP is to strengthen the institutional framework for carrying out its mandate of promoting price stability. One key element to achieving this objective is the restoration of the BSP's ability to issue its own debt instruments in the normal course of conducting monetary policy. This is being done through proposed amendments in the BSP Charter, which presently does not allow the BSP to issue its own freely negotiable debt instruments, in contrast to most of the other central banks in the world. The ability to issue the BSP debt we believe, will expand the BSP's monetary toolkit and enhance the flexibility of our monetary operations, particularly in dealing with periods of surplus liquidity. To complement this reform, the BSP is also pushing for the full capitalization of the BSP by the national government. Section 2 of the BSP Charter, or the new Central Bank Act, mandates that the BSP shall have a capitalization equivalent to 50 billion to be provided by the national government. When the BSP was established in 1993, the national government paid the initial 10 billion in the form of government securities, with the balance supposedly or originally to be paid within 2 years' time. So they have not yet made good on the remaining 40 billion, which we're hoping to ask them. Part of it has been due to budgetary constraints also, but with the improvement in the fiscal situation, we hope to get some help from the national government. As we have seen in the recent crisis, the size of a central bank's balance sheet determines the scope or the scale of its operations. So a bigger capital base will not only enhance the BSP's financial autonomy and credibility, but will also ensure that market operations will remain responsive to the needs or our mandate of promoting price stability. Another key element of for institutional reform at the BSP is the enhancement of the link between monetary policy and financial stability. A few of us will argue that close coordination of monetary regulatory and fiscal policies was critical to the restoration of global financial stability in the recent crisis. Currently, we are pushing for the inclusion in the the Interagency Financial Stability Forum of representatives from the monetary and fiscal authorities to provide a venue for better coordination of macroeconomic and financial sector policies in the Philippines. Having gone through the monetary responses to the implications of oil scarcity, I'd like to end by briefly noting that the non-monetary responses of policymakers to future oil scarcity are equally, if not more important. For example, given the potential loss of jobs and erosion of purchasing power due to persistent oil price increases, there might be a need for well-targeted and cost-effective social safety nets in the short run to help protect the poor. I know in most other Asian countries there are already some fuel subsidies and cash transfers. I think we've started to do the same thing as well. The government recently decided to provide a 1-month subsidy for public transportation at the cost of at the initial cost of 450 million. And proposals to expand the program are being studied as well. The thing I will say about these social safety nets is that in practice, the cash transfers might work better than subsidies, because subsidies, once you give them, are politically difficult to take back. Lastly, the potential surge of capital inflows from emerging economies is could also underscores the need for a multilateral solution. Individual countries may try to deal with the capital flows and the concomitant liquidity problems on their own through absorbing the liquidity and at the extreme imposing capital controls. But I believe it might the problem, since it's a global one, might call for a multilateral solution. So to this end, the dialogue within the region will also be important in dealing with these issues. So let me end there, and thank you very much.
Just some breaking news. Looking at the website, our monetary board has just decided to raise by 25 basis points yet again, confirming what our discussant has just shared with us, the bias towards tightening.
I actually already knew, but I wasn't sure if I could announce it to this room.
Okay.